Hello, and welcome back to Boni's Life, your home for intelligent, no hype crypto analysis. So, let's talk about the elephant in the room, or should I say the bull, the bear, or the confused kangaroo in the room? What on earth is going on in this market? Are we on the verge of a new all time high, or are we about to get rugged? It's a question that keeps traders up at night, scrolling through charts until their eyes glaze over. Well, tonight, we're going to cut through that noise. We're going to dissect the current market, and I'm going to give you actionable strategies, whether you're a short term degen, a mid term swing trader, or a long term visionary. We're going to use real hard data from our friends at CoinGecko and CoinGlass so you can make informed decisions, not just emotional ones. And don't worry, I'll try to keep the crypto bro jargon to a minimum. Let's get into it. First things first, let's get a feel for the room. What is the collective mood of the market? For that, we turn to the Crypto Fear and Greed Index. As of today, December 3rd, 2025, the index is sitting at a cool 28, which is in the fear zone. Now, just a week ago, it was at 15, which is extreme fear. This tells us something very important. The market is slowly, cautiously crawling out of a period of intense pessimism. It's like a patient waking up from a long slumber, still a bit groggy, but definitely showing signs of life. This isn't the euphoric greed of a full-blown bull market, but it's a significant improvement from the despair we saw just a short while ago. Now, let's look at the big picture. The total cryptocurrency market capitalization. Right now, it's hovering around a whopping $3.23 trillion. That's a 6.3% increase in the last 24 hours alone. This influx of capital is a strong signal that buyers are stepping in. But what's even more interesting is Bitcoin's dominance, which stands at a healthy 57.4%. When Bitcoin dominance is high, it often means that investors are seeking the relative safety of the king of crypto. It's the first port of call in a storm and the first to set sail when the weather clears. So, what does all this tell us? We are in a cautious recovery phase with bullish potential. The market is healing, but it's not yet ready to sprint. It's a time for smart, calculated moves, not reckless abandon. If you're a long-term investor, you're not concerned with the daily noise. You're playing the long game. Your time frame is the weekly and monthly charts. And for you, the fundamental picture is just as important, if not more so, than the technicals. So, what are the big picture fundamentals you should be watching? First, all eyes are on the Federal Reserve. The next FOMC meeting is on December 9th and 10th. And the market is pricing in an 80 to 87% chance of a 25 basis point rate cut. In simple terms, when interest rates go down, borrowing becomes cheaper, and investors are more likely to put their money into riskier assets like crypto. A rate cut could be the fuel that ignites the next leg of the bull run. On the technology front, we have the Ethereum Saka upgrade scheduled for this month. Without getting too technical, this upgrade is expected to improve Ethereum's scalability and efficiency. A successful upgrade could be a major catalyst for ETH and the entire altcoin market. And let's not forget the steady drumbeat of institutional adoption. Every week, we hear about another major financial institution dipping its toes into the crypto waters. This isn't just hype, it's a fundamental shift in the way the world views digital assets. It's the smart money entering the room, and you'd be wise to pay attention. Now, let's turn to the charts. On the weekly time frame, Bitcoin is currently trading around $92,923. The key level to watch is the 200-week moving average, which has historically been a major support level during bear markets. As long as we are trading above it, the long-term trend remains bullish. For the long-term investor, the strategy is simple but not easy. Dollar cost averaging, DCA. This means investing a fixed amount of money at regular intervals, regardless of the price. This strategy takes the emotion out of investing and allows you to accumulate assets over time. Look for key accumulation zones, which are areas of strong support on the weekly chart. Don't just hodl, hodl with a plan. Now, for you swing traders, the daily and 4-hour charts are your playground. You're looking to catch the medium-term trends, the swings that can last for a few days to a few weeks. And for you, the derivatives market provides a treasure trove of information. Let's head over to CoinGlass and look at open interest. Open interest represents the total number of outstanding derivative contracts that have not been settled. When open interest is high and rising, it means that new money is flowing into the market and the current trend is likely to continue. Conversely, a sharp drop in open interest can signal a trend reversal. Next up, we have the funding rates. In the world of perpetual swaps, funding rates are what keep the contract price in line with the spot price. When the funding rate is positive, longs are paying shorts, which means the sentiment is bullish. When it's negative, shorts are paying longs, and the sentiment is bearish. Right now, we're seeing a mix of positive and negative funding rates across different assets, which confirms our thesis of a market in a state of flux. It's a tug of war between the bulls and the bears, and you, the swing trader, can profit from the volatility. Let's not forget about liquidations. Liquidations occur when a trader's position is forcibly closed because they can no longer meet the margin requirements. Large-scale liquidations can cause sharp price movements. By looking at the liquidation heat map on CoinGlass, you can identify price levels where a large number of liquidations are clustered. These levels can act as magnets for the price. As a swing trader, your strategy is to identify the dominant trend on the daily chart and then use the 4-hour chart to find your entry and exit points. Look for pullbacks to key support levels like the 50-day moving average to enter a long position in an uptrend, and always use a stop loss to protect your capital. In this market, the swing trader who is patient and disciplined will be the one who comes out on top. Alright, you degens, this one's for you. The short-term traders, the scalpers, the ones who live and breathe the 1-minute and 5-minute charts. Your world is fast, furious, and not for the faint of heart. For you, the key is to be nimble and to react quickly to the ever-changing market conditions. Your best friend is the liquidation heat map. You're looking for those pockets of liquidity where a cascade of liquidations could send the price rocketing up or plummeting down in a matter of minutes. You're also keeping a close eye on the order book, looking for large buy or sell walls that could act as short-term support or resistance. Another powerful tool for the short-term trader is the long-short ratio. This ratio shows the proportion of long positions to short positions among retail traders. When this ratio is extremely high, it can be a contrarian indicator, suggesting that the market is overbought and due for a correction. Conversely, when it's extremely low, it can signal that the market is oversold and ripe for a bounce. Your strategy as a scalper is to identify a short-term bias, whether it's bullish or bearish, and then to trade in the direction of that bias. Look for small, quick profits and don't be greedy. A 1% or 2% gain is a win. And most importantly, risk management is paramount. Use a tight stop loss and never risk more than a small percentage of your capital on a single trade. The scalper's game is a game of 1,000 small cuts, not one big home run. So how do we put all of this together? How do we trade this cautious recovery market? For the long-term investor, the strategy is to continue accumulating at key support levels. The fundamental picture is looking increasingly bullish, but we're not out of the woods yet. Be patient and don't go all in at once. For the mid-term swing trader, this is a market of opportunities. Look for strong trends on the daily chart and then use the 4-hour chart to time your entries and exits. Be mindful of the derivatives data as it can give you an edge. And for the short-term scalper, the volatility is your friend. Look for those quick, high-probability setups and don't be afraid to take profits off the table. Here are some technical setups and triggers to watch for in the coming days. For Bitcoin, a decisive break above the $95,000 resistance level could signal the start of the next leg up. For Ethereum, a successful Saka upgrade could send it soaring past its previous all-time high. And for the broader altcoin market, keep an eye on Bitcoin dominance. A drop in dominance could be the signal that altcoin season is upon us. But remember, no matter what your trading style is, the most important thing is to have a plan and to stick to it. Don't let your emotions get the best of you. The market is a battlefield, and the disciplined soldier is the one who survives to fight another day. So there you have it, a comprehensive guide to trading the current market. Whether you're a long-term believer, a mid-term opportunist, or a short-term thrill seeker, we've looked at the data, we've analyzed the charts, and we've laid out the strategies. But at the end of the day, the only person who can make the right decisions for you is you. Do your own research, understand your risk tolerance, and never invest more than you're willing to lose. The crypto market is a wild and wonderful place, full of opportunities and pitfalls. But with the right knowledge and the right mindset, you can navigate it successfully. Thank you for joining me on Boni's Life. If you found this video helpful, please give it a thumbs up, subscribe to the channel, and hit that notification bell so you don't miss our next episode. And as always, trade smart and be well.